All right, everybody. So in under 20 minutes, I'm going to be showing you how to get 42 rental properties in 10 years, free and clear, all paid for, as well as lower your mortgage dramatically. Ready, set, go. All right. So when we get paid, the average American salary, husband for the wife, is $38,000 a year. We're going to go ahead and add that together. That's $60,000 a year. Then we're going to do it in monthly increments, which is $5,000 a month. And when they get paid that $5,000 a month, where do they put it? Inside of the checking account, right? So we have the checking account on this side, the savings account on this side, right? Okay, well, since that's the case, what happens when we live like that? Do we not have a cash basis that we're living on? And so that's what we're living by. We're living by the cash basis. Now, this is what I mean. When you have a mortgage payment of $1,200, you can't touch that mortgage payment for that month. So, I mean, if you do, you're not going to be able to pay the mortgage. All right? So let's go over here where the loans are. Okay? You have mortgage payment of $1,200 a month. Okay? You got a $200,000 mortgage at 6%. You also got a couple cars, right? And you're paying $600 a month on them. So we're going to put that right there. We're also going to have the national average credit card liability is $600 a month, and you have $600 a month right there. And you also have some expenses because you have a cell phone, you got that major data plan, you've got food that you got to take care of. Maybe you want to do some little dining out and all that. So you got $1,200 in expenses right here. You have $1,400 left. Where do they teach you to put it? Into the savings account, right? Okay, so you have $1,400 into your quote-unquote savings account. Now, the reason I put that in quotations is because the bank can call it whatever they want, okay? It's just an account where you put your money and you feel good about it because they call it savings. But really, it's a lending pool. Because if you saved up $10,000, okay, and you want a nice used minivan, you're not going to touch the $10,000 that you saved up. You're going to go get a loan at 6%. And guess what the bank is going to do? Because all of your savings accounts, like everybody that's contributed to the savings account, that's part of the lending pool. So your $10,000, they're going to take your $10,000, give it to you, and say, that'll be 6% interest. That sounds scary to me, okay? So that's what the savings account is all about. Let's go ahead and give you the $600 a month. We're going to show you what that looks like on the credit card side. So we're going to label this side lines. Okay, so lines over on this side and loans are over on this side. It's going to be very important, all right? Say you got a credit line of $15,000. You got a balance of $12,000 on the card. And your $600 a month monthly payment at 21%. Okay. Now there's a lot of people that are like, you know what, 6% is better than 21%. But I'm going to show you how 6% over here on this side is actually greater than the 21%, like by a lot. Okay. So anyway, so we have this model right here. This is called the employee mindset model. Okay, because $5,000 is going into your bank account and $5,000 is coming out of your bank account. That equals a cash flow of, what's 5,000 minus 5,000, guys? 0, okay? So you have a cash flow of 0 right now. Many of us were brought up with the employee mindset, and that employee mindset says, well, how much do I make? And we look at that top number right here, the $5,000, while the wealthy mindset is, well, how much do I cash flow? And that's what they're concerned about. So we're going to take a look at what the wealthy do in order to utilize their finances and have their money work for them. So instead of using a checking and savings account, that's not what the wealthy do. They actually bypass the checking and savings account and they put all their money into the lines of credit. Now, why would they do that? Well, first of all, you see this $600 a month minimum payment that you're making? right? Well, you no longer have to do that because all the $5,000 is going into your line. So you no longer have this payment right here, which means this payment is going to go down here, $600, right? And because we're not chumps, we're not going to have savings accounts anymore, all right? We're actually going to focus on cash flow. And so now we are up already to $2,000 a month in cash flow. So now that we have that, let's graph this whole concept so that we could get a better picture of what we're doing, okay? Let's graph it. We got $12,000 of balance. $15K is the limit. What happens when we put $5,000 into our line of credit? See, because no longer are we spending $5,000. We're now spending just $3,000, okay? The rest is actually cash flow. So let's do this. Let's graph it out. $5,000 in, $3,000 expenses. $5,000 in, $3,000 expenses. $5,000 in, $3,000 expenses. And all of a sudden, you can do the math. In 6 months, you'll actually pay off your line of credit in 6 months. This $12,000 line of credit is paid off in 6 months. Now, had you have done it the way the bank wanted you to do it, it would have taken you 4 years with your $600 minimum monthly payment, okay? Which one would you rather have? I'd rather have this one, not that one, okay? So let's go ahead and realize that we have a problem. We paid off our line of credit. So what are we going to do? I tell you what we're going to do. We are going to attack the mortgage. Oh man, we're going to show you how to pay that off in 5 years. However, before we do that, there are some people that maybe don't understand how a mortgage works. So I want to explain that next, okay? Watch this. Now, this is how your mortgage works. It's $1,200 a month, right, that you have to pay, okay, is divided up like this. $950 of it is going to interest, and $250 of it is actually going to the principal. So that over time, it actually looks like this, okay? And it's not until the end of the 30 years, that the interest is less than the principal, okay? So now the interest is $250 and the principal is $950 towards the end of you paying off that mortgage in the 30 years. But how many people do you know that have paid off their mortgages in the 30-year time frame? Less than 1% of all Americans who are current on their mortgage have ever made it to the 30-year time frame. What do we usually do? Refi, right? We're going to refi. Huh? Well, after this video, you'll never refinance again, okay? Look at this. You're going to pay all of that interest for the 7 years, you refinance, and you start all over again. So most of Americans are right here in this loop, stuck like Chuck. Let me tell you what goes on in 4 years, all right? So 4 years of you making that $1,200 a month payment, you would have paid $57,000. I want to show you how that $57,000 is divided up, okay? 48 months, let's go ahead and do it. 48 months, your principal equals $13,000, and your interest is $44,000. So in 48 months, you would have paid the principal of $13,000 and your interest is $44,000. Listen, that's too much. Stop doing it that way. I command you to stop, okay? There's a better way, and we're going to show you. May I suggest to you that you utilize your line of credit? And this is why, okay? You're going to utilize your line of credit to pay $13,000 towards that mortgage. So what that does is that takes a huge chunk off the back end of your $200,000 mortgage. So, and what you're going to do When you pay that down, you're going to pay it down the same way that you paid this down. You're still going to put all of your total monthly income into your line of credit, okay? Because remember, we need that debt, okay? We're going to use our line of credit as our new checking and savings accounts, okay? So it's going to look like this. As you write that check, 1 minute takes care of 4 years of payments. Watch this. You're going to write it, you're going to put it towards that mortgage, and then you're just going to pay it down. Now, if we paid off our $12,000 line in 6 months, how long is it going to take us to pay off the $13,000 balance? 6.5 months, okay? 6.5 months paid it off, right? Okay, so now that we've paid that off in 6.5 months, what's going to happen now? You just do it over and over and over again. So you're continuing to have those principal payments, okay? You're continuing to do that. So let's count up how much interest that we'll save doing paying our mortgage this way. You spent $13,000, right? So your principal payment was $13,000, and you paid that off in 6.5 months, and you had $1,400 in interest doing it the line of credit way. Now, doing it the mortgage way, the old mindset way, you would have paid $13,000 in principal payments. That took you 48 months. That's 4 years, and you would have made an interest payments of $44,000. So not only is doing it the line of credit way, paying your mortgage through your line of credit, shorter, you know, from 30 years to 5 years, it's also less expensive, like way less expensive. Isn't that awesome? That is awesome. So remember to pay your mortgage through your line of credit, all right? Not through your old cash basis living, okay? You're going to use your line of credit as your new checking account. So you're just going to continue to do that every 6.5 months. You're just going to write a check for $13,000, boom, 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 and continue to pay that mortgage payment from your line of credit, and you're going to save tons on interest, all right? So let's jump ahead 5 years, because that's how long it'll take to pay off that mortgage. So we jumped ahead 5 years, and all of a sudden, the mortgage is gone, right? Absolutely. And there's many of you that are saying, man, there's no way that that mortgage can be gone because that's 6% interest, and this is 21% interest. Well, there is a way that that mortgage can be gone, and I'm going to show you. Now, let me know something, okay? I'm going to write something on the board. I'm going to write 6 degrees Celsius and 21 degrees Fahrenheit. Could somebody please tell me which one is hotter? Okay, now why did you say 6 degrees Celsius was hotter than 21 degrees Fahrenheit? 6 is less than 21. We learned that in school, didn't we? But something we also learned in school is that these, Celsius and Fahrenheit, are 2 different units of measure. Well, guess what? The banks have done the same thing to us. They sure did. They didn't teach us that there's a difference between amortized interest, amortized one-directional interest, and simple interest, which is revolving. So what does that mean, simple interest revolving? Okay, simple interest revolving means you can go, once you pay the $600, right, a month, you can go to the gas station. You can go to the grocery store. You can eat out, you know, and you can swipe your credit card. Keep on going, keep on going. And you can pay and then utilize that money. But once you pay over here on your loans, can you utilize that money ever again? Can you swipe at the gas station? Can you swipe at the grocery store? Listen, 100% of your money is gone through a loan, while only 21% of your money is gone in your line of credit, meaning you can utilize that money again, okay? 79% of this money in your line of credit you can utilize, okay? And so it's much, which one is the better lending instrument? I mean, on all sides. Okay, so now we have paid off our loans, our loan for the mortgage, but we still need to pay off the car. So once we get rid of the $1,200 monthly payment, what happens? We get rid of budgeting for it, right? And we add that number to our cash flow. So now we're at $3,200 cash flow. All right, so now we're just having that cash paid down like you wouldn't believe. Okay, so now we're paying off our cars in 1 year, okay? And that's $3,200 cash flow. We're just paying it down, okay? Well, now what? Well, we get rid of that payment up there, and we put that payment into our cash flow. That's right. Good job. Cash flow. $600. That'll be $3,800. Now we got a huge problem on our hands. What's that problem? We're out of debt. And you thought it was going to take you 32 years to get rid of your mortgage and your cars. It would have doing it the old way, the old loan way. We're not doing it that way anymore. We're doing it the line of credit way. All right? It's only going to take you 6 years. So now, what we want to do is we want to get an asset, because that's what you're supposed to utilize your lines of credit for. Assets and emergencies. Okay? That's what you utilize them for. So what we want to do is help out someone who's almost in foreclosure. Don't you want to help out someone? Doesn't it feel good to help out people? Absolutely. So someone's almost going into foreclosure, and you're going to help them out. Okay? You are. And they're like, okay, well, what am I going to do? And you're the man with the plan. And you say things like, you know what, we're going to pay $10,000 to your bank. We're going to do a subject to. Okay? We're going to put $9,000 into the rehabbing this single-family rental here. And the $1,000, we're going to have you go get an apartment, okay? And the whole thing, this is a good idea because they get to avoid a 7-year ding on their credit, right? By avoiding foreclosure. And they also get to work on their credit because we'll be responsible for making those payments. Well, we won't be, but our tenants will be responsible for making those mortgage payments, right? And so when they do that, it'll increase their chances for them getting another home in the future. So $20,000, right? That's what the 10, the 9, and the 1 is. Okay, $20,000 down payment. Help them get out. This is a $100,000 mortgage, right? So the average monthly rent is $1,000 a month minus $600